Want to know what the top fear people have? It's the fear of the unknown. Well, the same holds true with purchasing your first home. There's a lot that goes into buying your first home. There's the mortgage, there's credit, there's income, there's employment, there's down payment, the area that you plan to buy, the type of home you plan to buy, how much the monthly payment is. There is a lot to consider. And that's exactly why I recommend a 1-year plan leading up to your first home purchase. Following this plan eliminates a lot of the stress commonly associated with buying your first home and any time crunch you may have associated with a lease expiring or some sort of deadline by which you need to make your first home purchase. It also allows you the opportunity to improve your situation gradually over time to best set yourself up for success, not only for the mortgage, but for your home as well. Let's get moving. My name is Scott Wynn, and I am a licensed mortgage advisor with the Wynn and Egan team at Citywide Home Loans. If you want to buy a home in the next 12 months, then click that subscribe button, and together we'll make it happen. All right, so let's step through what you should do leading up to the 12 months prior to your first home purchase. Well, the first thing that I recommend is that you know your credit score. But even this isn't as straightforward as you might think. See, there is a lot of credit monitoring services out there. The problem is understanding what's required for a home purchase and also understanding there's actually multiple credit scoring models. There's 3 different credit bureaus. They each have their own scoring model. And within those credit bureaus, they each have their own scoring model for different types of credit, whether you're purchasing a home or a car or getting a credit card. And so all of these things can be quite confusing to you as the consumer as you start planning your first home purchase and identifying where your credit is at and whether or not it is in position to be able to make a home purchase possible. So how do you go about pulling your credit report? Well, there are 2 ways. One way, if you don't want to contact a mortgage lender yet, would be to go to annualcreditreport.com. Federal law requires that you have the right to receive a free copy of your credit report once per year from each credit bureau. Well, annualcreditreport.com is the website that allows you to easily pull your credit reports from each of the 3 credit bureaus. Now, they do give you the opportunity to get your credit score. However, I don't normally recommend that you pay for your credit score. And the reason is because of the fact that the credit score you get is what's called a consumer score, not the mortgage score, which means that when the mortgage lender pulls your credit report, they're going to get a different score than what you would get as a consumer when you get your own credit reports. So instead, just get your credit reports. Getting a copy of your 3 credit reports, 1 from each credit bureau, will give you the opportunity to review your credit and identify if there's anything that is incorrectly being reported on your credit report. If you identify anything that is incorrect on your credit report, you have the right, according to the Fair Credit Reporting Act, to dispute that item and have it properly corrected on your credit report. The creditor then is required by law to respond within 30 days or have that item removed from your credit report. What you don't want to do is dispute any accurate items. Even if they're negative or derogatory and pulling your credit report and score down, you do not want to dispute any accurate items. You might dispute a negative item and have that item drop off of your credit report within 30 days if they don't respond, but you're running the risk that that item will pop back on your credit report without you realizing it and could negatively impact your ability to qualify for a mortgage. Can you do me a favor if you're finding this information helpful? Can you give me a like on this video so that I can reach more people that are interested in this topic just like you? So that's the first option, pulling your credit report yourself. The other option would be to contact a lender and have them pull your credit report. It's much simpler, much faster, and they can also provide you with additional tools and resources to help you in improving your score to a point that might be beneficial for mortgage qualifying. In addition, many mortgage lenders have an understanding of how credit works and what steps you can take to improve your credit over the next 12 months so that you can position yourself for the best possible mortgage terms. And that brings me to another tip that I would recommend during the 12 months leading up to your home purchase, and that is to get a mortgage pre-qualification in place. You can go all the way to getting a pre-approval, but I would at least recommend that you get pre-qualified. So what is a pre-qualification? Well, a pre-qualification generally is going to include running a credit report and completing a loan application, but not necessarily providing all the supporting documentation, such as bank statements and paycheck stubs and W-2s and tax returns and all of those sorts of things that require a lot more attention and eventually will expire anyway. So instead, getting pre-qualified will give you and the lender some level of confidence of where you're currently at and what you need to do to qualify, or if you're already qualified, to improve your qualifications so you can get better mortgage terms when you plan to make your home purchase. There are a couple things things you can do to potentially improve your credit score pretty quickly. One example is to increase your credit card limits. So if, for example, you have a $2,000 limit and a $1,500 balance, if you can get that increased to a $3,000 limit, what happens is your credit utilization ratio goes down. Your credit utilization ratio is the percentage of how much you owe versus what your limit is. So if you can increase your limit, even though your balance has not gone down, your credit utilization ratio has gone down as a percentage of your overall balance to limit. And so that can improve your credit score. The other thing you can do is to reactivate any dormant accounts. If you have any old credit cards that you haven't used for several years but are still open, it might be a good idea to charge a small amount onto those cards, such as some grocery visit or maybe getting gas in a vehicle, something along those lines, and then immediately paying off that balance in full. That will just reactivate the last reporting date of that particular card on your credit report, which can also have a positive impact on your credit score. Now, that's not always the case, and that's exactly why I recommend getting pre-qualified, because part of that process will be having a lender review your credit report and give you individualized, specific information on what you can do to boost your credit score to help you in qualifying for a mortgage. Another reason I recommend getting pre-qualified is because in many cases, you may believe that you have adequate income or employment in order to qualify, but the lender may have some specific rules that would stop you from qualifying. And knowing this 12 months before a home purchase rather than just a couple of months before a home purchase can make a big impact on your ability to actually make that home purchase possible. But it goes beyond credit and income. It goes to also identifying how much you can afford. During the pre-qualification process, the lender should be able to provide you a general idea of how much of a monthly payment you can afford, or calculating how much of a home price you can afford based on a comfortable monthly payment you believe that is within your budget. Once a pre-qualification or pre-approval is in place, I generally recommend that my buyers try their payment on for size. So here's what I mean by trying your payment on for size. Let's say you're currently paying $1,200 in rent and you're going to go to a $1,500 monthly housing payment, including taxes, insurance, mortgage insurance, and HOA. Well, that means that you're going to be increasing your payment by an extra $300 each month. Instead of just paying your $1,200 a month rent, now what I would suggest is take that extra $300 that you would have to pay towards a housing payment and put that into your savings account. And you should be able to, month after month after month, save at least $300. If you find it difficult to make that higher monthly payment, then you might want to visit where you're spending your money. Are you spending money on unnecessary or luxury items, things like coffees or beverages out, maybe eating out, going out for entertainment? If so, this might be an opportunity for you to consider reducing your spending on those luxury items and instead allocating it towards your future home purchase. It really allows you the opportunity to see if you can truly afford the monthly payment you are qualified for. But it also helps you in increasing your savings for that next home purchase. That can help with paying for down payment or closing costs. And if nothing else, it at least gives you an additional emergency fund in case something comes up after closing and you need to tap into that money for anything that is unexpected after closing. If you're unable to save $300 while renting, then it's unlikely that you're going to be able to afford that $300 higher payment when you buy. A lot of first-time homebuyers believe that they should pay off or reduce their debt, and that's not always the case. Instead, what I generally recommend, unless a loan officer has pre-qualified you and given you advice to the contrary, you should continue making your minimum payments to avoid any negative items being reported on your credit report. But outside of just the minimum required payments, I generally recommend first-time homebuyers or those considering a home purchase in the next 12 months to put that money in savings rather than paying off debt. And here is why. Cash gives us flexibility. If we are getting ready to make that home purchase and we need to pay down debt, well, we can then take the cash position you've saved up and apply it towards paying off debt. But if on the other hand, we need that money for something else, whether it's increasing your down payment amount or covering a certain amount of closing costs or buying down your interest rate, or potentially paying upfront mortgage insurance. All of these things are ways to improve or modify your mortgage program and qualification situation. Once you've had a lender complete a pre-qualification for you, review your credit report, review your loan application, employment and income situation, and have given you a general idea of how much you can afford, the next thing you might want to start doing over this 12-month period of time is putting together an all-star team to assist you with your home purchase. Obviously, at this point, you'll have a good lender in place that's helping you with increasing your qualifications so that you can get the best possible terms on your mortgage. And now you're going to want to get a real estate agent to help you with identifying the best home that will meet your needs and desires when you make your home purchase. Your lender will likely have a recommendation for a real estate agent. Most lenders work with many different real estate agents and can advise you on who they recommend can help you based on the area you plan to purchase in and your specific situation. But you might also want to check with family or friends, coworkers, anybody else that has recently gone through a home purchase transaction for a referral so that you have multiple options where you can then interview the agents based on what's important to you. If you do choose to interview multiple professionals, whether that's mortgage lenders or real estate agents, I would suggest selecting one as soon as possible. And the reason for that is because different professionals may have different opinions on what they are encouraging you to do. Having too many people involved with different opinions or advice can make the whole process overwhelming and confusing. So instead, select your one mortgage professional and your one real estate agent to take your advice from. The key is having somebody you trust to advise you to get you to the end goal of qualifying and making your home purchase with the best possible terms you can. From there, you're going to want to start pinpointing where you plan to buy. Are you going to buy close to where you live now? Are you going to move closer to family? Do you want to live close to work? Those are all different factors that you're going to want to consider. And if you're moving far from where you're at currently, you may want to investigate what those different areas are like. Consider how convenient of a location is it? Is it convenient to get onto the highway? Is it convenient for grocery shopping? Is it convenient for entertainment? Do you want a condo? A townhome, single family home? What's the difference? And what's important to you? Do you want something that's low maintenance? Do you want maybe a little more privacy than what a condo can provide? All of these factors are going to play into what type of home and where you plan to buy. And this is where the real estate agent that you selected can help you with identifying the type of home and location you plan to buy. With the area, type of home, and maximum limit on purchase price identified through the pre-qualification with your lender, your real estate agent should be able to put you on a drip showing you what homes are coming on the market that fit your criteria. As you start seeing homes come on the market for sale, you can really start to assess what is a need versus what is a want. For example, you might want a garage, but you need 2 bedrooms. So start making a list of what you need versus what you want, and then provide this list to your real estate agent to help them help you in finding the best home for you. And last, I'm going to recommend that you do not try to time the market. Yes, buying a home is a great investment, but trying to time the market so that you can get the best possible price before any market crash or bubble or anything like that is simply impossible. So don't do it. Instead, buy a home when it's the right time for you to buy a home. When you feel comfortable with where you're going to live for at least the next 5 years, and that you can afford that home, and that it will meet your needs for those next 5 years, then at that point, and only that point, should you buy a home. But don't delay a home purchase because of the fear of a market crash or correction or anything like that. And certainly don't buy just because home prices are going up quickly and you want to get in on the game. If you buy right, you'll end up positive in the end in most situations. Real estate is generally going to appreciate in value, but it does take time to recoup the costs of home ownership in terms of closing costs on the mortgage, real estate commissions when you sell, and home maintenance costs along the way. So generally, I recommend that you only buy if you plan to live in the home for the next 5 years to ensure that you'll have enough home appreciation to offset those costs.